Let me ask you something. You've been saving for a while, maybe a year, maybe 3. You said no to things you actually wanted. You were careful when everyone around you wasn't. And at some point, probably when you weren't expecting it, your account crossed $20,000. And now you're here, watching this video, which tells me one of two things. Either you already have $20,000 saved and you want to know what to do with it, or you're close and you want to be ready. Either way, you're in the right place. Because here's what I want you to understand before we get into anything else. Most people who reach $20,000 in savings don't hold on to it. They spend it, sometimes in one big move, sometimes slowly, upgrade by upgrade, and they wake up a year or 2 later wondering why they're starting over. And the frustrating part is that none of those decisions felt wrong at the time. They all felt earned. So today, I'm going to show you exactly what to do once you have $20,000 saved. Not what sounds good, not what feels exciting, what actually works, with real numbers, real data, and a clear order of operations that anyone can follow. Let's get into it. Here's something that most people don't know about $20,000. It's not a big number in the grand scheme of your financial life, but it might be the most important number you'll ever save. Because what you do with it right now in the next few weeks will determine whether it becomes the foundation of real wealth or just a chapter in a story about money you used to have. Let me give you some context for why this matters. The U.S. personal savings rate as of the end of 2025 sits at around 3.5%, according to the Bureau of Economic Analysis. That means for every dollar most Americans earn, they're saving about 3.5 cents. That's it. Meanwhile, total credit card debt in the United States just crossed $1.277 trillion. That's the highest number the Federal Reserve Bank of New York has ever recorded since they started tracking it in 1999. And the average interest rate on that debt is sitting around 22% annually. So you have a country where most people save almost nothing and owe a record amount of money at near-record interest rates. And into that landscape, you've managed to build a $20,000 cushion. That puts you ahead of most people, genuinely. But here's where it gets complicated. The Federal Reserve's own research from 2024 found that 30% of American adults cannot cover 3 months of expenses by any means. Not with savings, not with borrowing, not with selling assets. Another 15% could scrape it together, but not easily. That means roughly half the country is one bad month away from financial crisis. And here's the part that should concern you. A lot of those people also had $20,000 at some point. They just didn't use it right. The mistake isn't usually dramatic. It's not one bad investment or one catastrophic decision. It's a pattern that starts the moment someone reaches a savings milestone. They treat the milestone as an arrival instead of a starting line. A slightly nicer car, a better apartment, a vacation that felt deserved, each one justified, each one reasonable, and each one carrying a monthly cost that quietly eroded every dollar they'd saved. The car payment alone, the average new car payment in America right now is around $735 per month, according to Experian. That one decision, held over 30 years of investing instead of paying car debt, would be worth over $1.6 million at a 10% average annual return. One car, over $1.5 million. I'm not saying don't have a car. I'm saying understand what every financial decision actually costs. Not the sticker price, but the compound cost over time. Because that's the math most people never do. So before we talk about what to do with your $20,000, we need to talk about a few things you should not do. And then we'll get into the exact order of operations, step by step, that will actually move this money in the right direction. But first, there's a question you need to answer before you do anything else with this money. Do you have debt charging you more than 7% interest? Credit cards, personal loans, store financing? If the answer is yes, that debt gets paid before you do anything else, before you invest, before you open any account, before you do anything I'm about to tell you. Here's why, with math that's hard to argue with. The average credit card APR right now is around 22%, according to Federal Reserve data. If you have $10,000 in credit card debt at 22% and you only make minimum payments, you will spend over 18 years paying it off, and you'll pay roughly $14,000 in interest alone. You'll pay the bank more than you borrowed just in fees to keep that debt alive. Meanwhile, the S&P 500 has returned an average of about 10.4% per year over the last 100 years. That's the best performing broad market index in American history. So the math is simple. You're paying a guaranteed 22% to the bank, hoping to earn a potential 10% from the market. That's not a financial strategy. That's paying $2.20 to make $1 every single day. I want to tell you about someone I know who had $18,000 saved and $11,000 in credit card debt at 21%. He decided to invest the savings because he'd read that compound interest can't wait, and he didn't want to miss the market. Over 3 years, his index fund gained about 28%. His $18,000 grew to roughly $23,000. But during those same 3 years, he paid close to $7,000 in credit card interest on minimum payments. His $5,000 gain cost him $7,000 to achieve. He ended those 3 years $2,000 poorer than if he had just paid off the debt first. And when I showed him that math, he looked at me like I had just ruined something for him, because nobody had ever made him do the actual calculation. The rule: any debt above 7% interest gets eliminated before you invest a single dollar. Credit cards at 22%, gone first. Personal loans at 15%, same. Federal student loans at 6.5%, that's borderline. I'd lean toward paying those off too, because a guaranteed return always beats a potential one. Once the high-interest debt is gone, the next move is the emergency fund. And I know this sounds boring. That's fine. Boring is the point. An emergency fund is not an investment. It doesn't grow. It doesn't generate returns worth talking about. It just sits there. And that's exactly what makes it powerful. Here's what happens when you don't have one. Let's say you've paid off your debt, you've put $15,000 into the stock market, and you're feeling good about it. Then your transmission goes out, or you lose your job, or you get a medical bill. You don't have cash, so you have 3 options. Sell your investments, possibly at a loss, definitely with tax consequences. Put the expense on a credit card at 22%, or just don't handle it and hope the problem goes away. All 3 of those options are terrible, and all 3 of them happen because you skipped this step. The emergency fund is what lets you stay invested when the market drops 40%, because when your roof is leaking and your car won't start and you haven't slept in 2 days, the only thing standing between you and a terrible financial decision is cash sitting in an account you can access tomorrow. How much do you need? If you're single, renting, and have a stable job, 3 months of essential expenses. We're talking rent, utilities, groceries, transportation, not restaurants, not subscriptions. For most Americans, that's somewhere between $6,000 and $10,000. If you have kids, a mortgage, or variable income, freelance work, tips, commission, you need 6 months minimum. That's $12,000 to $20,000 for most households. Where should this money live? A high-yield savings account. Right now, in February 2026, the best high-yield savings accounts are paying between 4% and 4.20% APY. New Tech Bank is at 4.20%. Axos Bank is around 4.21%. These are FDIC insured, which means your money is backed by the federal government up to $250,000. It won't make you rich. It's not supposed to. It's supposed to be safe, accessible, and earning something real while it waits. The national average savings account rate right now is 0.39%. If your emergency fund is sitting in a regular checking or savings account at your local bank, you are leaving several $100s a year on the table for no reason. Move it. But here's where actual long-term wealth starts to get built, and it's simpler than almost anyone makes it sound. Debt is gone. Emergency fund is set. Now you invest. And the first place that money goes is a Roth IRA. For 2026, the IRS allows you to contribute up to $7,500 if you're under 50. That limit was officially confirmed by the IRS in November 2025. If you're 50 or older, you can contribute $8,600. To be eligible as a single filer, your income needs to be under $153,000 per year. Most people watching this qualify. Now, why a Roth IRA specifically? Why not a regular brokerage account? Why not a 401k? One reason, everything that grows inside a Roth IRA is tax-free. Not tax-deferred, tax-free, forever. Here's what that means in actual dollars. If you're 25 years old, you put $7,500 into a Roth IRA today, and it grows at 10% per year, consistent with the S&P 500's 100-year historical average. By age 65, that $7,500 becomes approximately $339,000. You will not pay taxes on that $331,500 in gains, not a dollar. If that same money were in a taxable brokerage account, you'd owe somewhere between $50,000 and $66,000 in capital gains taxes when you withdraw it. You're essentially locking in today's lower tax rate on the money you put in and getting the entire return, 40 years of compound growth, completely tax-free. Where do you open one? Fidelity, Charles Schwab, and Vanguard are the three most straightforward options for most people. No fees on the accounts, clean interfaces, strong reputations. Pick one, open it today, it takes about 15 minutes, and contribute whatever you can up to the $7,500 limit. But here's where most people blow it, even after doing everything right up to this point. You've opened the Roth IRA. You're staring at thousands of options: stocks, ETFs, mutual funds, target date funds. You don't know where to start. Here's the answer. VTI or VOO. Pick one. Stop thinking about it. VTI tracks the entire U.S. stock market, about 3,500 companies. VOO tracks the S&P 500, the 500 largest companies in America. Both have an expense ratio of 0.03%. For every $10,000 you invest, you pay $3 per year in fees. $3. The S&P 500 has returned an average of 10.4% per year over the last 100 years, according to data going back to 1926. Over any 20-year period in American market history, it has never produced a negative real return. Not once. And here's something important to understand. You are not trying to pick the next great company. You're not trying to find the stock that's about to explode. You're buying the market itself. When you buy VTI, you own a small piece of Apple and Google and JP Morgan and 3,497 other companies. If one fails, the others absorb it. If the American economy grows, which it has over every meaningful time horizon in history, your investment grows with it. Let me show you what that looks like with your $20,000. If you invest $20,000 in VTI today and never add another dollar at 10% annual return, in 10 years, you have about $51,875. In 20 years, $134,500. In 30 years, approximately $349,000. You put in $20,000, you end with $349,000. The other $329,000 came from time. But if you invest that $20,000 and add just $300 a month on top of it, less than most Americans spend on food delivery, after 30 years, you'll have over $800,000. Your total contribution would be around $128,000. The other $672,000 came from compound interest doing its job while you lived your life. Invest $20,000 today at 10% for 30 years to $349,000. Wait 5 years to start and $216,700 over 25 years. That delay costs you roughly $132,300. 4 years and 4 months of your working life spent making it up. Procrastination isn't free. It has a price tag. But here's the mistake that even smart, disciplined investors make and quietly destroys returns. The market is near all-time highs right now, and I know exactly what your brain is doing with that information. It's saying, maybe I should wait for a pullback. Maybe I should hold cash until things correct. I understand the instinct. It sounds logical. It almost never works. Here's why. The stock market spends the majority of its time at or near all-time highs. That's not a red flag. That's what a growing economy looks like over decades. If you only invested when the market was below its all-time high, you'd spend most of your investing life sitting in cash. There's a well-known research study that looked at the worst possible market timer in American history. An investor who put $2,000 per year into the S&P 500, but only at the absolute peak, right before every major crash from 1970 to 2013. The dot-com bust, the 2008 financial crisis, Black Monday, every single one. You know what happened? They still ended up with over $1.1 million because they stayed in the market. Because time in the market is more powerful than timing the market. J.P. Morgan ran a separate analysis on this. If you invested $10,000 in the S&P 500 in 1993 and stayed fully invested through 2013, you'd have $97,700. If you missed just the 10 best days out of roughly 5,000 trading days, you'd have $49,000. 10 days cut your returns in half. And here's the detail most people miss. The best days in the market almost always happen right after the worst days, when everyone is panicking, when the news is terrible, when your gut is screaming to sell. That's when the recovery starts, and the people sitting in cash waiting for clarity miss it every time. The research is unambiguous on this. Time in the market beats timing the market every time, without a single historical exception. But here's the thing that undoes all of this progress for most people, and it happens so gradually they don't even notice. You've saved $20,000. You feel successful. And somewhere in the back of your mind, a very reasonable-sounding voice starts up. It says, you've been driving that same car for 5 years. You've been in this apartment for 3 years. You've been eating lunch at your desk while your coworkers go out. You've been patient. You've earned something better. That voice is the most expensive voice in your financial life. Let's look at what it actually costs in real numbers. The average new car payment in the United States right now is around $735 per month, according to Experian. Let's say you go more conservative, a used car at $450 a month. That's $5,400 a year. Over 30 years, $450 invested monthly at 10% becomes approximately $1.02 million. You traded a slightly newer car for $1 million in retirement wealth. And in 2 years, that car will feel just as normal as the one you were already driving. Or the apartment. You move somewhere $400 more per month. That's $4,800 a year. Over 30 years, $400 invested monthly at 10% compounds to over $900,000. $900,000 for a kitchen you'll stop noticing in 4 months. This is not me telling you to never upgrade anything. It's me asking you to understand the actual cost of every financial decision, not the monthly payment, but what that monthly payment costs you over the length of your working life. Most people who stay financially stuck aren't spending recklessly. They're making 100 small upgrades that each feel justified, each one reasonable in isolation, each one carrying a monthly commitment that makes it harder to build wealth. The people who end up financially free aren't the ones who made the most money. They're the ones who kept their fixed expenses flat while their income and investments grew. Every dollar that doesn't go toward a higher payment is a dollar that can compound for you instead. Let me show you what this looks like in practice. Same starting point, $20,000 saved. Same income, same city. 2 completely different outcomes. Person A follows the order of operations. They use the money as a foundation. They pay off the $8,000 in credit card debt they've been carrying. They build a 3-month emergency fund in a high-yield savings account at 4.20% APY. They max their Roth IRA for 2026, $7,500 into VTI. They set up a $350 automatic monthly contribution to a taxable brokerage account, same fund. And then they don't touch any of it. They keep the same car, they don't move, they don't upgrade. They live about the same life they were already living, just with a lot less financial anxiety because they now have an emergency fund and they're actually investing. Person B gets to $20,000 and feels like they've arrived. They trade in their car. Nothing crazy, just something nicer. $480 a month. They move to a better apartment, $350 more per month than before. They invest $3,000 in a few individual stocks a coworker recommended. The stocks go down, they feel burned, they stop talking about investing. In 5 years, here's where they stand. Person A has a net worth somewhere between $85,000 and $115,000, depending on market performance. They've had an emergency fund for 4.5 years and haven't once had to put a crisis on a credit card. They're starting to genuinely understand what it feels like to have financial options, and they haven't felt deprived because they've forgotten most of the things they didn't buy. Person B has about $11,000 in savings, the same credit card balance they had 5 years ago, it never fully went away, a car payment for 2 more years, and a monthly budget that's tighter than it was before, even though they make more money now. They tell people they're bad at saving. They're not. They just spent their foundation before they built anything on top of it. Most people follow Person B's path. Not because they're undisciplined or uninformed, but because every single one of Person B's decisions looked reasonable in the moment. Every upgrade felt earned. Every delay felt temporary. The difference between these two people isn't intelligence, it isn't income, it isn't luck. It's one decision made once about what $20,000 actually is. Person A decided it was a starting line. Person B decided it was a reward. One of those decisions leads to financial freedom, the other leads back to zero with a nicer car. Here's the complete playbook in plain language. First, any debt above 7% interest gets paid off before you do anything else. That's your guaranteed return. Second, build 3 to 6 months of expenses in a high-yield savings account. Right now, you can find rates between 4 and 4.20% APY at FDIC-insured banks. Third, open a Roth IRA, contribute up to $7,500 for 2026, and buy VTI or VOO. Don't research, don't wait, just buy. Fourth, put anything left into a taxable brokerage account in the same fund, set up automatic monthly contributions, and let it run. That's the whole thing. It's not exciting. There's no secret. There's no special insight that the wealthy have and you don't. There's just this, a boring plan followed consistently for a long time. You already did the hard part. You saved $20,000 when most people around you saved nothing. You proved you can delay gratification. You proved you have the discipline. The only question left is whether you'll use that discipline to build something that lasts or spend the next few years rebuilding from zero with a slightly nicer lifestyle. You know the answer. Now you have the roadmap. Go do this.